All right, welcome back to Starting Your Investment Journey audio series. Now, my name is Abiodun Adelu, and I believe that you already know that my passion is to help people build successful and meaningful lives through better decisions about money, about work, about wealth, and about personal growth. Now, in this episode, we're going to talk about diversification, right? Now, imagine that you meet your friend, and your friend just tell you that I have just found a perfect investment for me. And you ask the person, what kind of investment is that? And then they tell you that, okay, there's this specific investment that they've just found. And then they now added something. They now said, I put all my money into it. Well, maybe they are right. Or maybe they have discovered something incredible. But a good investor immediately becomes nervous. And they become concerned that this is not right. Now, not because the investment is bad, but because of what we're about to say next. So, diversification exists because the future is uncertain. That's it. That is the entire reason why we feel that this thing is not right. It is not because the investment is bad. It is because the future is uncertain. Nobody knows the future with complete certainty. Not you, not me. Of course, not professional investors, not economists, not fund managers, nobody. So what we can do is to make educated estimates. We can analyze data, we can improve our odds, we can check some of those things. But certainty does not exist. And diversification is how investors respond to that reality. Now let's look at a simple analogy. Imagine that you're a farmer and you have one piece of land, and you just decide to plant only one crop, just one. So what happens if that crop performs fantastic well? Then you're good. If it performs well, that's fantastic. You do very well. But what happens if diseases affect that particular crop, or weather affects that crop, or demands fall for that crop? Suddenly your entire harvest is affected. Now, imagine another farmer on the other hand that instead of planting only one crop, they plant several crops. Now, if one struggles, the other may still perform reasonably well. The second farmer may not always have the biggest harvest, but they are less likely to have a disastrous harvest. That exactly is how diversification works. Diversification is not about maximizing return. It's about reducing the chance of catastrophic outcomes. So that distinction is very, very important. Many beginners think that diversification exists to increase return. Often, it's just to improve your ability to survive various things that can happen. So, because in investing, you don't have to be right all the time. You just need to avoid being disastrously wrong. So that's it. So, but why is it that some people feel that single investments actually feel more attractive? It is because human beings, we are naturally wired to like concentration. We naturally like concentrations. We like stories about people that did something and then they got successful. We like certainty. We like confidence. So if someone says that this stock is going to double very soon, or this property market is guaranteed to boom, or this cryptocurrency is the future, or they tell you that this thing is where the future is, just put all your money in. Our brain love that kind of simplicity. Something that just tell me what is going to work and let me put all my money into it. We like it. But reality is really that simple. That's the truth. The future usually contains surprises, shocks, unexpected events, and changing conditions. So diversity acknowledges that uncertainty in the future, and that is why we have diversity. Now, let's think practically. An investment can be affected by four big sources of uncertainty. Four big sources of uncertainty. Number one is company risk. No matter how good your company is, whether it is your personal business or a business you put your money into, they may perform poorly. That is the fact. Number two is industry risk. Sometimes it's not even the specific company, it's just the industry. So it's possible that an entire industry may struggle for a period or even struggle for several years. Number 3 is economic risk. So it's possible that the broader economy in that particular country, it's possible that the economy weakens over time. So there's economic downturn, there's economic recession. There are many things that could happen that are not expected. And number 4, of course, is global risks. So events around the world can affect markets everywhere. I remember speaking with a forex trader recently, and she was telling me how some of the news that the US president released recently scattered a lot of markets, and many people lost a lot of money, right? So global risk can affect the market, can affect not just the market for forex trade, it can affect market for demand and supply of any products in the world. So all those things have impact on your investment. So a diversified investor recognizes this possibility, and instead of putting all of their things, all of their investment in one place, they find a way to diversify strategically. I think that is also very important. It's not just about putting your money everywhere. It's about doing it strategically. Now, let's bring together what we've learned in the previous episode. We've talked about different asset classes, and we said that they behave differently. Now, financial assets behave differently from real assets. Business assets behave differently from bonds, and cash behave differently from equities. Because they behave differently, combining them can reduce vulnerability, right? So if one area struggles, it's possible that another area remains stable. And that doesn't then necessarily eliminate risk. What it does is to spread the risk. And that is an important thing that we need to pay attention to. Diversification is not about owning everything, right? People think that what it means is that you should have a little bit of everything, buy a little bit of everything. No, that's not what it means. What it means is that you avoid having your entire financial future depend on one outcome. That is very critical. Now, let's look at a real life example. Now, suppose someone tells you that all my wealth is tied down to one business. That's possible, right? Now, what happens is that if that business succeeds, they do well in life. What happens if that business struggles? Then their entire financial life is affected. But imagine another person that has some business ownership here, they have some financial investment there, they have some cash reserve there, and they have some exposure to real assets here. So what happens? Then they have more resilience. Now, it's not like any of those approaches guarantee success, but the second person has more resilience, right? So that is it. So one of the most famous ideas in investing is often summarized like this: don't put your eggs in one basket. I know you've heard it before. Don't put all your eggs in one basket. Of course, it's a cliche, right? But cliche often survive because they are true. The real lesson isn't that baskets are dangerous. It is that accident happens. What if somebody eats your basket? Somebody mistakenly just eats your basket. What happens when you put all the eggs in one basket? So the goal of diversification is not to get rich overnight. The goal is to stay in the game long enough for wealth to compound. And that may be the most important insight for this entire episode, that you don't leave the market before you even succeed. So the game of the strategy is to stay long in the game, enough for wealth to compound over time. Because wealth is built by surviving mistakes, surviving uncertainty, surviving unexpected events. And so it is not by making one perfect prediction, right? So the key takeaway from this episode is that diversification exists because nobody knows the future. Nobody knows the future, right? It's an acknowledgement of our limitation as humans, that we are uncertain about the future. So that is it. So the way we build against that uncertainty is by diversification. Now that you understand why diversification exists, now the next question is that what exactly are we diversifying into? Diversifying into what? What role should different investment play inside a portfolio? Because not every investment has the same role, right? So that's where we're going to look. That's the next thing we're going to check, right? So thank you for listening, and always remember, learn before you invest. Like I always repeat, don't put your money into what you don't understand. Build understanding before you buy, and always approach investment with long-term Thank you very much. I will see you in the next episode.